All right, everyone, welcome to the webinar. It looks like we are at 4 o'clock, so we're going to go ahead and get started. Dan and Tim, take it away.
Thanks, Brooke. Happy to be here this afternoon with Tim Anderson. We are going to be discussing some of the overlooked provisions of the CARES Act, specifically in the taxation realm, talk about how they're interacting with all the other initiatives that are in place right now, PPP loans, EIDL loans, things of that nature. It's too much to learn in 1 week, Tim. I can't myself feel like I'm keeping up, but I don't know, every day presents a new challenge. So,
and honestly, we're on an hour by hour with some of these concepts.
We are.
Particularly this afternoon, there's been some debate, and we'll get to that. We wanted to welcome you from the Cooper Norman Studios, this side of the Tetons.
Yeah, that was great.
Hopefully all of you are in your foxholes or bunkers. I wanted to say it's kind of a dangerous thing to ask accountants to do social distancing, especially when they've never been socially present their whole life. I think we have people living in caves.
Yeah, this is business as usual for us, honestly. This works great. So it has been a busy week, though. Look forward to the time we can get back to taxes. Tim, a couple things that are on my mind as we're kind of approaching this CARES Act. I think first and foremost, it's important to understand that the CARES Act is not a tax piece of legislation, despite the fact that it contains several tax provisions, and a lot of the initiatives that have been pushed through from the House and the Senate and our president focus around modifications to taxation. It is not in and of itself a tax bill. In your mind, does that create maybe some challenges for regulatory agencies in interpreting this and maybe helping us understand it as well?
I do. I mean, everything that's happened to date has been timing. I mean, it just so happens that the virus attack happened during tax season. Congress wanted to get immediate relief to the people. The fastest way, I think, in their minds was to go ahead and say things that would influence this tax season. People could get dollars in their pockets right away. But we'll be battling this for a couple of years, I think.
I think likely so. It was a unique time just because this is the one time where taxpayers are actually transacting with the government right now by way of estimated tax payments or paying amounts that are owed on a 2019 filing or getting refunds for overpayments as well. The timing and the fact that it touches so many tax aspects of a U.S. citizen's life, I guess we shouldn't be too surprised at that, as it's going to be the fastest way to provide aid and relief to taxpayers and to individuals.
And so everybody should be aware. I mean, we're dealing not only with the IRS, we're dealing with the Treasury Department itself. There will be Social Security issues. We have a lot of government agencies that are going to be influencing what happens.
Certainly, and many of them actually haven't weighed in sufficiently, I think, to help us understand what all of these laws mean. Truthfully, it's hard to understand a piece of tax legislation absent the IRS giving a form or some guidance or a publication surrounding it that helps us interpret what that law might mean. So it's fair to say that although the CARES Act is passed, there's a lot that still has to be said from several regulatory agencies to help us understand what this means.
Now, we recognize the elephant in the room is the loans. Everybody is talking about the Small Business Administration loans, and we will touch on that today. But our goal today was to help you understand that there are things you can be doing under the stimulus acts today that will give you guaranteed money, not only if you're just holding out for the loans.
Agreed. So I want to approach this bill. We have one of our panelists that's unmuted. Could all the panelists please ensure that you're muted, please? I'm going to break up this CARES Act, I think, into two provisions. Let's talk about the individual provisions and then talk about the business provisions. And then at that point, let's conclude by talking about PPP loans and EIDL loans and how they fit into this mosaic of data that we're trying to get through. Starting with individual provisions, the one that's probably most widely discussed is the stimulus check or the stimulus bill that's in place right now for American taxpayers. It's similar to, I think, other stimulus initiatives we've seen in the last 20 years. It certainly does bear some characteristics that are unique for itself, but it is very similar to what we've seen before. Tim, walk us through maybe just some of the basics right now. What are some of the things that individuals are going to get, maybe some of the timing that they can expect as well surrounding the stimulus check?
Okay. I mean, everybody's probably familiar with the numbers. Adults are going to get $1,200. If there are dependent children under the age of 17, they will be paid out $600. We're left with this 17 through 24 gap. If you have dependent children who are adults, what's going to happen to them? And we've got some insight to share some strategies on that. But right now, the party line is that money will be paid out in the next 3 weeks.
Mm-hmm.
There are a lot of commentators that are saying there's no chance. But right now, the federal government is committed to getting that money out in the next 3 weeks.
That money's going to take several forms. Well, a couple forms, I guess. First of all would be direct deposit. If they have direct deposit information for these taxpayers available, it'll become by way of direct deposit. That information is generally shared on income tax filings. Second way would be by check. Third way would be by a rebate or a credit that they would receive on their 2020 tax return. It's an interesting way that they're calculating this. They're looking at, they want to ensure that individuals that have over a certain AGI, married filing joint individuals over about $200,000, they're not going to see any benefit from this. They're looking at 2018, 19, and 20 income tax returns, kind of presenting, I guess, to taxpayers right now a dilemma of whether or not to file. In your mind, what are the things that people should be thinking about as they approach that?
So you say 2020 tax returns, but I haven't filed that yet.
Mm-hmm.
I think we should point out that this is an advanced payment of a 2020 credit. Those of you old enough to remember the Bush era, there was something similar. There was an advance payment made that was reconciled on the next tax return. So next year, when you file those taxes for 2020, you'll be asked to say whether or not you received a stimulus payment.
Mm-hmm.
So getting back to which year they're going to look at, right now, the rule is if you have not filed your 2019 taxes yet, they will automatically look to your 2018 filing.
So if I'm filing, truthfully, I'm going to be saying to myself, what was my adjusted gross income in 2018? What is it going to be in 2019? Should I postpone the filing of my 2019 return to ensure that they reference or look at my 2018 filing in the determination of my stimulus check?
I think that's a great point, because they have come out and said, they being the federal government has come out and said, when you file your 2020 taxes, if you have earned too much money in 19 and or 20 and you already received a stimulus check, you don't have to pay it back.
Yeah. In my mind, this creates a little bit of a dilemma for an individual that perhaps has already filed their 2019 return and has reported to the IRS a disqualifying amount of income. In that instance, perhaps in 2018, they would have qualified, 2019 has disqualified them, and perhaps 2020 will also disqualify them. So it's created a weird nuance for the very proactive filers to miss out on an opportunity, perhaps just based on the fact that they already reported their 2019 filings. I'm wondering if we'll see additional guidance here that provides some relief for those individuals that decided or elected to file timely.
Yeah. Nice guys finish last.
Yeah, certainly.
Let's talk strategy for a minute.
Sure.
So if I'm on the cusp
Mm-hmm.
of that threshold and I exceeded the threshold for 18 and I exceeded the threshold for 19, but due to my employment arrangements or my business, if I'm a business owner, I can somewhat control what my taxable income is.
Mm-hmm.
Could I push my income down for 2020 to make sure that I qualify for that credit when I file my 2020 tax return?
It's a good question. I think it widens for taxpayers the time frame that they have to evaluate to ensure that they get that money. Self-employed individuals, particularly that have depreciation elections to make, or cash basis taxpayers that have the ability to time when certain transactions take place, there's a great opportunity for them to say, all right, how can I best plan my 2020 AGI, or what decisions can I make right now to ensure that I get this check? The conversation feels a lot like the pass-through deduction conversation that we have about certain thresholds and saying, okay, well, taxable income at 315 or 323 means something, you know? This is another threshold that I think taxpayers need to pay attention to.
Okay.
There are taxpayers, Tim, that have not filed tax returns in a while, and that could be for completely legitimate reasons. Certain Social Security recipients don't file because they don't have to, and there's some concern because they are looking at income tax returns to determine whether or not they will receive a stimulus check. There's some concern over those that haven't filed in a while, whether or not they're going to get a benefit. And I think up until probably on, I think Monday of this week, we really didn't have a good feel as to whether or not how we would help those individuals. What does the IRS put in place to help those
Well, I was
individuals?
going to say at the beginning of this week, I mean, the IRS was saying, well, those people are just going to have to file a zero tax return.
Mhm.
But we've just received word yesterday, that if you are receiving regular government payments, whether through a pension from the U.S. or from Social Security,
Mhm.
they've got your bank account information and they will transfer that to you.
That's right. The IRS also published that they're going to have an online portal where people can enter their information that perhaps haven't filed returns in the past and enter their information and solicit that stimulus check. We're both kind of grinning a little bit because I think deep down we think this is a way to track people that haven't been filing their income tax returns in the past. I sure hope that isn't the case, but it certainly did cross my mind when I read that.
Well, let's talk about the kids in the basement.
Yeah.
The adult children.
The 18 to 24-year-olds. I think the takeaway here is there's a conversation to have with your CPA as it relates to those individuals. In order for a dependent child or just some other dependent, the 18 to 24-year-olds, they have to demonstrate that they're providing more than one half of their own support. There's a demonstration that they have to provide to the government. So if you have dependents that are filing tax returns pursuant of trying to get some stimulus money, but that same tax return reports no taxable income, I wonder if the IRS is going to take some issue with that. If they're going to be concerned that a dependent is trying to claim a stimulus check while simultaneously reporting little to no taxable income.
And this is kind of a paradigm shift. I mean, for years, we've said, well, yeah, I need to claim that kid as a dependent because I'm better off.
Right.
This may be the year to reconsider that, especially for, you can get a dependency deduction for that child for 2019 because they're still living in your basement. But in 2020, you may want to have that child file their own tax return and get some of the stimulus payment that they otherwise would have qualified for.
Certainly. I'm wondering about a taxpayer that doesn't qualify for the child tax credits or the other dependent credits. Taxable income well over $400,000. Those individuals probably have, and suppose they haven't filed their 2019 tax return yet. There's probably a conversation to have right now about what dependents are on that return and whether or not a decision should be made right now as opposed to in 2020.
Yeah, I mean, if they're not doing you any good anyway on your tax return, see what you can get.
Agreed. On your screen, you're going to see an illustration that outlines, based on your filing status, how much of a rebate you can expect to get based on how many dependents you have and based on your adjusted gross income. We will be providing these slides to all of our panelists. Feel free to review this graphic and other information as time provides or necessitates. Okay, let's talk about retirement plans. I had some great conversations with some financial advisors today as well that we trust to kind of get their feedback on this. The overall takeaway, Tim, is that taxpayers can take up to $100,000 out of their plan. Each individual can. So a spouse and a taxpayer can both take $100,000 each out of their retirement plan pursuant to some coronavirus-related, interruption that they've had in their life. That definition feels rather wide. Is it your opinion that most taxpayers are going to be able to demonstrate to the IRS that they are undergone sufficient economic harm to consider taking money out of their retirement plans free of this 10% penalty?
I think with a lot of these, the IRS is going to be hard pressed to say that anybody wasn't affected in a negative way. So in my mind, as ambiguous as this discussion is, I think people are, probably well within their rights, especially in Idaho, to claim some impact and try and avail themselves of some of these benefits.
Fair enough. The IRS has outlined, those 4 bullet points on the slide outline an eligible taxpayer to take these withdrawals from their retirement plan. Again, the provision here is that you can do so without having to pay the additional 10% tax for an early distribution. The distribution is still taxable. They're spreading, though, the time over which you have to recognize that taxable income. So suppose you take the full $100,000 distribution from your retirement plan. You don't have to pay the 10% penalty, which is great. That would otherwise be a $10,000 hit to your tax bill. You are going to recognize, though, income in those 3 subsequent years, I guess recovering the fact that you did take a taxable distribution from your retirement plan.
And I probably should have said at the beginning of this topic that there is a penalty if you are not at least age 59 for taking money out of a retirement vehicle without an exception. So, generally that's been hands off as people have considered sources of funds. But now that money is available to take from an IRA, from your 401k. One thing we were able to confirm this afternoon is the 401k does not have to have in-service distribution rights or provisions. So we see this as a great opportunity for people.
So simplify that for, I guess, our viewers. They may not be familiar with what in-service distributions mean. I think you're referencing that each retirement plan has plan documents that govern how that retirement plan is to be administered. And there was a fear that we'd have to modify all of these retirement plan documents to accommodate this law. You're telling us they don't need to be concerned about that.
That's right. There doesn't have to be a modification to a plan, and the plan is not in jeopardy by making these distributions. Most plans that I've reviewed don't have any language saying that you could take money out before you leave the company or retire. So certainly this would be an opportunity.
Absolutely. So funds are available there that can be taken by a taxpayer free of that penalty. I think what's great news too is that if the taxpayer takes the money and they resolve a short-term need and want to avoid the taxation associated with this distribution, they can work with their financial advisor to pay those amounts back to not only avoid the 10% penalty, but also taxation associated with that distribution as well.
So let's say I'm not committed to paying tax on it when I get the money out. Can I decide later?
I think you have a time frame to make a decision here. I certainly do. My conversations with financial advisors make the time frame almost feel actually quite fluid, almost all the way up to that 3-year period to make some decisions related to what you want to do with that money, whether you want to repay it, whether or not it was exhausted by some need that you had here in 2020 as well.
Wow. So here's a devious thought I've had. What if we have a fairly young worker, young as in under the age of 50, who has been in a traditional 401k plan? So that means that contributions are pre-tax. And here we are with a low stock market. It's a buyer's market in the stocks. What if they were to take money out of that traditional 401k plan and then reinvest them into a Roth IRA?
It's a great question. So I called the financial advisor today about that. And, I think it presents a very unique opportunity for individuals to do a Roth rollover in a very tax advantageous way. My biggest concern there, Tim, is that it states that the distribution has to be taken for those that are experiencing adverse financial consequences from being quarantined, furloughed, or laid off. So if those funds were taken out and then placed right back into a qualified plan or some other retirement vehicle, I have some concern that they may not be able to demonstrate to the IRS that they were addressing a hardship. Does that make sense?
And I would argue that in this instance, which is different than the other parts of these stimulus bills, is that they have not said what you have to spend the money on. They said you have to show a hardship. I agree. But I think I'm going to say they don't tell you what you have to spend it on.
Certainly a planning opportunity there. Something to discuss with your CPA. Talk with Tim after 5 o'clock on a Friday.
In April, I get really easy.
Yeah, you do. Good deal. Okay, charitable contributions are something else that was modified with the bill. The modifications were unusual. I'm going to say the modification felt unusual. We live in a very charitable community, individuals that are very charitably minded. However, most taxpayers are not encountering the limitation that's placed, at least historically, on charitable contributions. Can you familiarize us a little bit with maybe what that historic limitation was and what this modification did?
Yeah, so quite a few years ago, Congress was afraid that people were going to artificially deflate their income by making large charitable contributions. So, and this was, even back as far as the 80s, that they put a ceiling on the amount of charitable contributions someone could make to decrease their income. They traditionally, for a long, long time, it was 30%. Recently, in recent years, we've had a 50%, depending on which charities you gave to. Right now, with the stimulus acts, they've raised that to 100%. So effectively, someone could give charitable contributions and zero out their taxable income.
Unique circumstance here. Given all the different ways that people can give charitably, whether that be through private foundations, non-cash contributions, conservation easements, it's important to note that the CARES Act is addressing very specific types of contributions, namely cash contributions. Non-cash contributions, other things like that are off the table. Even those payments to donor-advised funds are off the table in the calculation of a 100% exhaustion of your AGI through a contribution.
So I couldn't zero out my income with Deseret Industries contributions.
You could not. You could not this year. That would be awesome, though, wouldn't it? I think there's a unique opportunity, though, for taxpayers that are timing their charitable contributions based on the standard deduction. Many taxpayers are saying, the standard deduction is so favorable right now at $24,000 that I make my charitable contributions every other year so I can maximize my itemized deductions. This is an instance where even those individuals that perhaps are on an off year, a year where they would not be making charitable contributions, still should make a $300 charitable contribution because they will receive that as what is known as above the line deduction, a deduction directly off of their adjusted gross income.
That's a good point. I want to back up a minute and just say, if you're using a donor advised fund, that will not qualify for this 100% limitation.
Correct.
It'll still be stuck at the 30%.
Correct. So this $300 amount that at least everyone is incentivized to do, where would you put that $300, Tim?
Well, this is my challenge to every single listener that's out there today. I challenge everybody to make a $300 contribution to a school this year.
Or in a youth rehabilitation organization as well.
Youth rehabilitation organization. Especially if you live in Idaho. In Idaho, we have a special credit. So you are able to take 50% of your donation up to $2,000 as a credit against your taxes. And if you remember, a credit is better than a deduction. So a $2,000 contribution to a school in Idaho will save you $1,000 on your Idaho taxes. Now, my challenge is to pay at least $300 because you'll get that above the line deduction on your federal taxes for 2020. Plus, you'll get a $150 credit against your Idaho taxes, plus the deduction that you already got on your federal taxes.
So kind of doing the math, a $300 contribution, let's just say they did the $300 amount, would probably only end up costing a taxpayer $30 to $40 maybe when it's all said and done between the credits and the deduction that they would afford themselves.
And you can't tell me there's not a school that doesn't need this.
Sure. Great thought. So a great opportunity for taxpayers to evaluate what organizations are perhaps state advantaged in credits or additional deductions as well too. If you're going to make that contribution, identify one of those. I like that idea. All right, student loans paid by employers, unique opportunity here. I have fielded so many questions from clients that have perhaps let's say a physician right out of school that has a lot of student debt, just new employees that they want to find ways to help them with either their student loan burden or their current education expenditures that they have. What's a workaround here? Well, this CARES Act provided, I think, a really unique opportunity, and that it's allowing an exclusion of up to $5,250 of aid that an employer provides to an employee, so long as those funds are used in either repayment of an existing student loan that the employee procured. It can't be for a spouse or anything like that, but student debt related to that employee, or for the payment of tuition and other qualified expenditures as well. Very unique opportunity. And I think we're going to find that most taxpayers, at least business owners, are going to probably be utilizing this provision.
Can the business owner use it for himself?
That's a good question. You actually answered this question 5 days ago. I'm going to let you answer that.
Well, this stems from a law we've had on the books for a while. An employer can provide a scholarship to employees for $5,250. This number hasn't changed for a long time. What these stimulus bills have done is they've said, okay, this doesn't have to be a scholarship at this point. What you can do is you can offer it as an employee inducement to them to repay some student loans. Now, so we go back to those old rules, and the old rules say it can't benefit the owner or anybody related to the owner.
Is it your expectation that those rules will persist even through this new act?
Yeah.
Okay.
Yes.
Now, what's unique about this law is that it states that this $5,250 can be paid to the employee or directly to the institution that is being, where the liability exists, whether that be a university or the student loan holder, the lender. Unique instance here where employees are receiving this money directly, it'd be my expectation that perhaps the employer would have to maybe document that the employee in fact used those funds to pay student debt themselves or tuition. I don't know if we have sufficient guidance at this point to know where that burden lies, but certainly something to be aware of, that if you're paying it directly, I think that we may still have, the business owner might still have some stewardship over ensuring those funds being used for correct purposes.
And I think here's where the guy with the tie differs from the guy without the tie is, I would say that the employer's obligation ends with verification that a loan exists. I would say the employer doesn't have the requirement, just because of the way the law was written, to make sure that the employee spent it on that. The fact that they're allowing the employer to put the cash in the hands of the employee tells me that as soon as he documents that the employee has a student loan.
So you are referencing, though, a documentation standard that
Yes.
at least the employee has asserted to the owner that a student loan exists. This would be one of those instances where additional clarification from, I think, our regulatory agencies is going to be helpful.
Sure.
Half of Tim's clients are in federal prison right now, so. Let's go on to the business provisions right now of this law, talking first about payroll tax deferrals. We're going to, Tim, what I want us to do is kind of go wide and then narrow our focus down to specific instances. Starting with this payroll tax deferral, this is one of those wider reaching provisions for business owners, okay? Payroll tax deferral is really what it states, is that it's a deferral or an ability to defer payroll tax until the end of the entirety of payroll tax that they incur between now and December 31, 2020. In your mind, what business owner is not going to do this?
Well, here again, I mean, in its simplest form, you could say this is another tax-free loan, interest-free loan. Exactly. I mean, and this really doesn't have the restrictions that other loans do.
The portion that they're allowing you to defer is the 6.2%. The employer portion of that Social Security can be deferred. If you're self-employed, it's 50% of your Social Security burden that you bear. Now, the Social Security burden, that payroll, that Social Security tax, Social Security, I keep saying that, self-employment tax burden is generally reported and paid on that taxpayer's individual income tax return. So there's going to probably need to be some additional clarification provided on what the deferral period is and when they need to pay that back if you are self-employed. What we know right now is that they can defer those taxes, the payment of those taxes, all the way through December 31, 2020, and are obligated to pay that back on two anniversaries, one being December 31, 2021, and the second one being December 31, 2022.
So if you're a self-employed person, quite often you'll even up the score with the IRS on your self-employment taxes when you file your 1040 in April.
Mm-hmm.
And you'll calculate for the year what your total self-employment tax was, which is your Medicare and Social Security, and you'll pay it with your income taxes. So what Dan is alluding to is many of our self-employed people will defer ultimately when they get to next April and file their 2020 tax return. Other people who are receiving a wage from a regular payroll will have the option starting right away. I think it started last Friday, to defer this tax. And, just as a reminder, an employer collects Medicare and Social Security tax. Every bit of Medicare and Social Security tax paid by the employee is matched by the employer. So this is a deferral of the employer's portion.
Correct.
Of the Social Security, not the Medicare.
Correct.
And again, another opportunity to save some money right away.
Absolutely. Everyone qualifies, no need to demonstrate harm associated with what's going on right now. Everyone will qualify. As far as how this is accomplished, I think we need to look to our quarterly payroll report filings. It's my expectation that additional lines will be added, allowing for the carryover of this deferral so that it will add to each, preceding 941 leading up to the point at which they do need to pay it.
So one fear I have in this is people are going to forget. They're going to forget, oh yeah, in 2020, we've only paid half. How do you think this is going to be regulated? Do you think you're just going to run a tab with the IRS that they're going to track?
I think there's going to be some self-reporting that's going to be required here. I think the 941, similar to any other tax carryover that's reported on your 1040 or on your corporate returns, I have an expectation that there's going to be a spot where you indicate the deferral amount and it's going to keep carrying over. Speculation at this point, but I'm guessing that it's going to be the obligation of the taxpayer to demonstrate that they acknowledge that deferral.
And I will say, if there's one area that the IRS is not loose with, it's payroll taxes.
You're exactly right. It is a very intransigent aspect of the tax law, very much so. Okay, we've talked about deferrals. Let's talk about the payroll tax credit refunds. And to understand this provision, Tim, people have to first understand another act, another bill that was passed before the CARES Act. There was an act called the Families First Coronavirus Response Act that passed about a week, I'd say, probably prior to the CARES Act.
We had 3 bills 3 weeks in a row.
Yeah. It's too many. The FFCRA, or the FMLA, and it goes by a couple names here, was designed to help employees that were in danger of being unemployed, I guess, or in danger of not having work to do based on either a governor mandated shutdown, based on being ill themselves, or based on their need to care for someone that was ill. Now, we're not going to go over those provisions today, but there were credits that are created for employers that adhere to those provisions. Many employers here in Idaho in particular, these provisions didn't come fast enough, quite honestly. They were required to place people on unemployment, to furlough individuals, to take other steps to help preserve cash flow. For those that still do have a workforce that are going to be adhering to the terms of the FMLA, there are payroll tax credits out there for you to go and get. In my mind, Tim, a business owner needs to acknowledge really what this act is. The design of this act is to say the federal government acknowledges that there is going to be an economic burden or a failure for business owners to be able to pay payroll, that revenue is going to be stinted, that they will have a hard time with cash flow. And so all these programs, if you look at them for really what they are, is the federal government's desire to cover a burden that will exist probably in a 1 to 2 month time frame, we hope anyway, right? This is one of those initiatives where they state the amount that you're paying those individuals through the FMLA, 100% of what you're paying them, if you can demonstrate that it's in compliance with that act, will come all the way back to you as a payroll tax credit, a refundable credit too in some instances as well.
And we should say, I've been telling clients that as you're considering these, if you have employees that are not working, decide right now why they're not working. Are they at home under the fear of the coronavirus? Are they at home under the fear of their relatives having or getting the coronavirus? Are they at home because a dependent child can't go to daycare or to school? Those are all the categories for the FFCLA. Now we're going to get to the CARES Act, which has its own payroll credits.
It does.
And then we're going to talk about which one you choose.
That's right. The CARES Act, what this accomplishes, it tells us how, or at least it's providing guidance on how we can get those credits. 2 weeks ago, I was concerned that business owners would have to wait until they filed their 941s to claim these credits and get them back. Very recent guidance has provided us information that Form 7200, it's a new form that is either presently available or will be available very shortly, is a form that a business owner can file several times within a quarter to request incremental refunds of this credit. So suppose you're a business owner, you've just undergone a 2-week payroll, you've paid out these non-productive individuals, you've been compliant with the FMLA. In that instance, you can demonstrate or report to the IRS your compliance and request from them a refund. And I think if you do this right, indication we can file this several times. If we continue to do this, we might be able to stay on top of the cash flow requirement associated with payroll and keep business owners afloat just by filing this form frequently.
So you have to have already paid the payroll.
You do.
But very soon after you pay the payroll, you could tell the government you want it back.
That's right.
Or you want your reimbursement.
That's right. And that's accomplished with Form 7200.
Okay.
So again, that can be filed several times within that quarter prior to that 941 being filed. The 941 will also be a further reconciliation, perhaps of what credits have been taken, what remaining credits still have yet to be taken as well. Payroll compliance has just become very, very difficult at this point, as so many of these initiatives are focused around credits in the payroll realm.
How soon will you get the money?
That is unknown at this point. That's a great question. It's my expectation that since they've told employers that they can file this form several times within that time frame, I'd hope that we'd see probably within 5 to 7 days of filing that you'd see that refund.
So what if I don't want to mess with 7200? That could get really messy.
It can. You would just wait until you filed your 941s and reconcile it at that time.
So I may wait until the end of the quarter and then just tell with my quarterly reporting, hey, a bunch of the payroll tax I paid you, I want it back.
That's right. That's right. Absolutely.
Okay.
Now, Tim, you alluded to the CARES Act having its own version of this FMLA, this credit for amounts that you pay to employees that are afflicted by the coronavirus, either economically or physically. There is that credit within the CARES Act. It's known as the Employee Retention Credit. This is a credit you have to read slowly to understand. It is a difficult one to unpack. So it's my goal that we can understand this as we work through it, okay? Let's start by first understanding what parameters an employer has to be under prior to qualifying for this credit. This is not for everyone. This is for very specific individuals that are directly impacted by a shutdown, their business, or their business has been, I guess, economically impacted by this to a substantial degree. Now, there's calculations that you'll run, we'll talk about in just a minute, but you have to demonstrate one or the other, either that you are shut down or that you have undergone substantial harm economically. That credit it's designed to encourage business owners to keep on their payroll despite the fact that they may be non-productive. The credit is calculated in a very convoluted way. The way it works is that they will take the wages that you pay to these afflicted individuals, the wages that you pay to these employees, including the health benefits, and will give you a 50% credit on those wages that you pay up to $10,000 for each employee, okay? Now this is reconciled quarterly. You cannot go over $10,000 for a single employee in the aggregate of all quarters. Okay, it is only a credit available to the extent of $10,000 per employee. I'm sorry, $10,000 in wages. See, this is why it's so complicated. I'm sorry, $10,000 in wages, which means that the employee per employee, the only benefit you're going to get is $5,000. Let's run through a scenario real quick, make sure we clarify this, okay? Tim, you have 3 employees, okay? All of them afflicted, let's say all of them infected at this point, okay? They're at home. You've retained their payroll, okay? You're continuing to pay them. And you've paid them each, let's say $15,000, $17,000, and $20,000. In this specific instance, you will get a credit for 50% of their wages up to $10,000. So in other words, you will get a $5,000 credit for each of those employees. Does that make sense?
Yeah.
Okay.
Do they have to be infected?
They do not have to be infected. Your business has to be in a position. In fact, the way that they phrased it is that the employer's business must be fully or partially suspended by government due to COVID-19 during that quarter, or the employer's gross receipts have to be below 50% lower than the comparable quarter in 2019. So they are going to be looking at the prior year to set benchmarks to state whether or not you've been economically harmed. Now, if you just barely hit that threshold and you have some recovery, they will allow you to continue to utilize that credit until you've recovered to the extent of about 80%. So you dip low enough to qualify, you can have a recovery period and still enjoy the credit.
So over the course through the end of the calendar year, you may be able to get this $5,000 per employee.
That's exactly right. Now, there's thresholds that are in place for over and under 100 employees. Strong recommendation to talk to your CPA about the calculation here, because it is convoluted at this point. But the short of it is that if you have under 100 employees, the calculation or the determination of whether or not those employees can or cannot work is lightened. It's a much more lax determination at that point. So those that have fewer than 100 employees are going to enjoy this credit much more freely than those that have over 100 employees.
Okay, so a scenario that keeps coming to my mind is a physician. You know, many physicians are closed or have scaled back. So by and large, what we've seen is initially they sent people home because of the threat. Mm-hmm. Those people have not become infected. But they've continued to pay their salaries. Mm-hmm. However, to maintain a certain amount of revenue in the practice, these doctors have kept a skeleton crew on to help emergency procedures. What do they use? What do they avail themselves of?
In this instance, if they have fewer than 100 employees, let's suppose this practice is a smaller practice, fewer than 100 employees, then they can utilize the entirety of that payroll in this calculation to arrive at that $5,000 credit. If they have over that amount, I see need for them to be far more specific about their calculation.
Could they use the FFCLA rules for
Certainly.
The employees that went home?
In fact, what's important, and it's important that we come to this point right now, that all of these initiatives, I spoke earlier stating that the federal government's goal is to provide aid during this difficult time, and their specific focus is payroll. They are also equally concerned about redundancies. They are very concerned that the PPP loans that are presently being issued by lenders at this point, that the FMLA credits that are available, that this employee retention credit will provide to employers duplication of benefits. So each of these provisions state very clearly that you cannot utilize PPP funds and simultaneously enjoy this credit, or you cannot use PPP funds and simultaneously enjoy the benefits of FMLA, that they are to be segregated, and you are to enjoy the benefits associated with each provision individually.
So recommendations for people paying payroll.
Right now, well, I hate to fast forward probably to the end of our presentation, but it'd be wise to speak with a lender at this point. I'm beginning to think.
Okay.
Speak with a lender.
As far as these payroll credits go.
As far as the payroll credits are concerned, I think you need to evaluate your ability to cash flow it over this short time frame before you can file a Form 7200 and get some of that money back. It's a cash flow question in my mind, Tim. I mean, would you interpret that differently?
No, that's the standard talk that I have with clients today is, what do we need to do to keep your business healthy over the next few months?
Absolutely.
Liquidating your business at this point to get the tax credits doesn't make sense.
No.
One thing that I would recommend is if you are running a payroll in your business, I think it's incumbent on you to keep very good records as to who you're paying that's not working, who you're paying that is working, and who you're paying that has gone home under the threat of the coronavirus. Because those are three different scenarios. You could avail yourself on each employee of each of these programs and not double dip like Dan warned us about.
Absolutely. The one provision that we don't have a slide for that is, I think, most present in Idaho business owners and other business owners as well, is the fact that they've had to rely on state unemployment to cover a burden at this point. That cash flow does not provide the ability for this business owner to continue to, I guess, participate in these credits and follow this subsidized route that the government has put in place. I don't find myself being critical of that approach. I think at the end of the day, each business owner has to evaluate which course of action is going to be best for them, whether that be laying individuals off and allowing those employees to participate in what is an enhanced unemployment benefit because of the federal government's additional amount that they've placed within there, whether or not to participate within these credits, or whether or not to pursue PPP loans or use some combination of all of these over the course of the next several weeks.
I think there are plenty of people right now that have been laid off that are making more money today than they were at work.
The benefits right now are rather enhanced. My concern is that Idaho and perhaps other states are falling a little bit behind in the implementation of that federal advantage that they put in place, that additional $600. It's just not fast enough quite yet. So we'll get there eventually. My concern is that long term, my fear, just like the passage of this act, is we're going to find ourselves 2 to 3 weeks always a little too late on a lot of things. I hate to sound dismal there.
Well, and another concern that comes up is how do you make sure your key employees stay there?
Right, absolutely. Employee retention credits are going to be claimed on Forms 941 starting with the second quarter. So June is when they're going to be able to first start claiming those credits. Form 7200 will also be in play in there to help people grab some of that money faster as opposed to waiting until the filing of a quarterly report. Okay, let's talk about net operating losses real quick. Stepping away from payroll and other things of that nature, let's talk about net operating losses. So very, again, it felt like a familiar provision, Tim, provision that we've seen before as it relates to the ability for a taxpayer to carry back net operating losses. It might be helpful to explain what a net operating loss even is. Let's use an ag producer because it seems that they're the ones that are capable of generating losses of this nature perhaps more readily than other business owners. Suppose that an ag producer is capable of, between depreciation and other expenditures, pushing their income so dramatically below taxable income that they generate a loss. And that loss completely eliminates taxable income. No burden exists at that point. And that loss, at least historically, has carried forward several years and can be consumed by subsequent, I guess, in recognitions of taxable income in each following year. Example being in 2018, say they recognize a $100,000 loss. That loss could be utilized in subsequent years to consume taxable income. This is a widening of that benefit dramatically, and also an opening in my mind of 8 years worth of tax returns to find benefits. Give me an example, I guess, in your mind, a taxpayer that, not necessarily a taxpayer that comes to mind, but an example that comes to mind that perhaps our listeners could use in evaluating it or asking themselves, maybe this is a provision that fits for me.
Well, I'm thinking of, maybe a contractor. 2008 was a horrible time for the economy, and especially with contractors, they had bad years after 2008. So, if you had bad years continuing into
17, 18, 19.
17, 18, 19, and you had, losses carried forward, that would allow you to reduce your income going forward.
Mm-hmm.
If for whatever reason in the last few years, you have had a bad year that created a loss, but this loss followed a very good year. Just this morning, we were talking about a client who had a banner year in 19, multi-millions made, but now is facing bankruptcy because of the turn in the energy sector.
Mm-hmm.
it'd be nice if we could wash those two instead of having very high income in one year, very low income or a loss in the other.
Mm-hmm.
So net operating losses allow us to do that. In 2017, with the tax reform, Congress was obligated to put some provisions in place to make sure that they could pay for these tax reductions somehow, or somehow put a lid on them. And one of the things they did is they said, we're going to limit the amount of net operating loss you could deduct in any one year.
Mm-hmm.
With these stimulus bills, they've said, you know what, we're going to take the lid off.
You can take the entirety of the loss in the year in which you're carrying it forward to. Furthermore, if you incurred a loss in 18, 19, or 20, you can carry that loss back 5 years. Find a year in the last 5 years to 8 years where you had a large amount of taxable income and initiate a refund in that specific year.
Can you even remember 2013?
No. 2000. I'm wondering if I even have my own tax records from 2013, honestly. But yeah, this bill is allowing taxpayers to look back all the way to 2013 and say, okay, in which of these 8 years did I pay a lot of tax? And which of these years did I have perhaps a net operating loss? Can I carry that loss back and get that money back? Unique opportunity here. So if listeners, if there are those that are saying, I did have a net operating loss, I have a net operating loss carryover right now, or I exhausted a net operating loss just recently, there's a conversation to be had with your CPA to say, okay, should we apply this back as far as 2013 and initiate refunds today?
Because in case anybody's forgotten, prior to 2017, we had some very high tax brackets.
We did.
I mean, some people at the top were paying almost 50% between federal and state. It would be nice to get some of that back.
Certainly. In my mind, this widens the differences between our federal and our state taxation authorities. I doubt the states are going to follow in this provision. So we'll be generating federal refunds.
Good point.
Our state NOL carrybacks are going to remain very different than the other ones, right? So it's going to create some complexity, but I think a great opportunity for business owners to generate refunds if they've undergone some of these abnormalities in their businesses. I like that thought. Okay, we're getting close to the conclusion of our presentation. We're going to talk about qualified improvement property, and then we have some questions that have been prepared. We'll be addressing some of those questions. Tim, I'm thinking if there are other questions that haven't been answered or anything that we can still help with, I think perhaps we'll do our best to send an email that addresses some of those questions, and then perhaps ask you to solicit the help of your Cooper Norman advisor to answer any other questions that they may have at this point.
Oh.
Let's start by talking about qualified improvement property. If you have made substantial improvements to real estate that you own in the last 2 to 3 years, this is something that may apply to you. In the past, prior to what is known as the TCJA, that is the Trump tax laws that were passed 2.5 years ago, prior to that time, you could only write off certain improvements that you made to a building. They were known as qualified leasehold improvements or qualified restaurant improvements or just qualified improvement property. They were in 3 specific buckets, and it was kind of burdensome, quite honestly, to try to determine which improvements you could, write off at a 50% bonus depreciation, and those improvements that you couldn't do those with as well. It was the intent with the TCJA or the Trump tax laws to widen investment opportunities for businesses. They wanted to be able to tell business owners, whatever you invest in, we're going to create a tax advantage behind that. And that came in the form of bonus depreciation, that you could write off just about anything that you bought. This was a unique instance where I think a legislative oversight created a weird bubble over this last 2 years, where they consolidated all of this improvement property into a single definition, really alleviating the burden for us in trying to determine, okay, what improvements can we put at a 15-year life and write off, and which of those can we not? Consolidated all those definitions, and it failed to tell us that it was in fact qualified property to write off under bonus depreciation. It has been known as an oversight for a very, very long time. They fixed that oversight. So Tim, which taxpayer needs to be concerned about this right now? Who needs to be saying, I need to talk to my CPA about this?
I'm going to boil it down to this. If you have remodeled an older building in the last 3 years, take a look at how that has been written off. Because if for some reason that was given a 39-year life, potentially that could be written off immediately, or you could take it on an amended return for the year you took it in service.
Absolutely.
So yeah, definitely a lot of people occupy older buildings, always remodeling. Go ahead and take a look at that.
I like that. For everyone's edification, the definition of improvement property, kind of the property we're looking for to say if this has happened in the last 3 years, it's improvement to an interior portion of a building that is non-residential, as long as that improvement is placed in service after the building was first placed in service. So an improvement to an older building, like you said. QIP, or qualified improvement property, specifically excludes the enlargement of a building, elevators and escalators, and the internal structure framework of a building. So there's a lot there to look at based on what few exclusions they put in there.
Yeah, so if you've done a build out and you're a tenant, that could be written off.
Absolutely.
You don't have to be the building owner.
Let's go to our questions right now. Tim, what questions are you seeing right there that appear to be most prevalent? Do you need a moment? Would you like me to cover a couple of the provisions while you
go
do
ahead.
that? Okay, a couple of the provisions that I'll review while Tim's reviewing those questions. The Act provides for the exclusion from tax, the forgiveness of small business loans. Don't let this language fool you. They are specifically speaking of SBA type loans. For those of you that are looking at EDL and PPP loans, these are things that you've already perhaps probably just encountered and have done your best to understand at this point. There have been enhancements to high deductible health plans that allow for telehealth to be a provided service. Certain other products are now components of HSAs as well. And the business interest expense limitations, historically at 30%, have been to 50%. The takeaway there for business owners is that they have enhanced the deduction that business owners can enjoy from business interest expense. All great provisions, pretty easy to understand though in their individual application. Would you like more time?
No.
Okay.
Some of the questions. Dan, this is from your mother. You're invited for dinner on Sunday.
All right. She hasn't let me visit her actually since this all happened.
No, we've got a question here from David. Let me just pull that up. I know, I just saw it.
I should have asked a man of Tim's age to handle the tech portion of this. I'm sorry.
Okay. Can an individual contribute to multiple individuals' student loans and receive that $5,250 benefit multiple times?
It's by the employee. So if the employee has that cost, then that is a benefit that they can provide for each employee that is qualified.
And you know, one idea I had surrounding this, and tell me what you think, Dan, is if you get to bonus time with your employees and you're going to pay them a bonus, could you give them the option of paying that towards a student loan and having them receive it tax-free?
I liked that idea. Yeah, in that specific instance, you probably want to help them place that money in a good spot. Again, difference between tie versus no tie. But you'd probably want to help them place that money, you know, where it needed to go. But I liked that idea a lot, actually.
Sure. Okay. All right. If Brooke, you can forward on any other questions we get. There's one down here by David I wanted to get to. Here's one right here from Taylor. On the stimulus check, if your income was over the threshold in 2019, but in 2020, your income is below the threshold, will that be a tax credit when filing in 2020 in addition to normal credits?
Yeah, so the way they phrased this is that it is an advance of a credit that will exist on the 2020 return. So the answer is if you disqualify in 2019, but will qualify in 2020, you'll enjoy that tax credit when you file in 2020.
So an anonymous question, what's the upper limit for the charitable contribution donation that we described?
100% of your adjusted gross income. So suppose that you made $100,000, it's $100,000. Again, specific types of contributions. We're talking about cash contributions, very, very limited scope of types of the type of contribution that qualifies.
Okay, so no ceiling.
No ceiling.
Or on the $300 above the line.
Right.
Okay, let's go to payroll tax credits from Laura. Other webinars have indicated we cannot defer these taxes if we have PPP loan. Is that correct?
That's a great question. Now, as I mentioned, that a lot of these programs cannot work in connection with one another, that they are designed to be mutually exclusive. I think that that guidance that they're hearing from other webinars is likely correct. Tim, you're probably going to have to help me on this one. Is it your understanding that that's also the case?
Yes. I mean, they've really tried to draw a hard line to say, if you're going to participate in these loans, we're going to try and restrict you from the other benefits that we've created through the stimulus packages.
That's right. Now, certainly the credits deferral based on what you provide, what information you provided as well. That's right. I mean, you need to be viewing this kind of like as a one or the other kind of circumstance, but also perhaps an opportunity to use a myriad of these programs in connection with one another, just not simultaneously. That perhaps the program right now makes sense for the next 2 to 3 weeks, then you may have a time frame under which you'll utilize a different methodology.
Sure. From an anonymous attendee, can you use the payroll tax credits if you have a PPP loan? I think we just addressed that.
Yep.
From Casey, would any of these provisions be able to provide, I just jumped, a credit or refund of self-employed health insurance premiums for the owner and family?
Well, so the calculation of that payroll tax credit includes the health benefits as well. So included, I guess, in that $5,000 per employee amount is health benefits that are provided. I'm not sure I'm getting to what Casey's question is. Are you interpreting that question differently?
I'm wondering if he's thinking of buying insurance through the exchange, if you're receiving the advanced credit.
The subsidy there?
Yes.
Okay.
If this has interplay with that. I wouldn't think so.
Not that I'm aware of. That's a great question though, Casey. That is perhaps something that we could do a little bit more research on and provide some guidance on.
Okay. Will there be any forced reporting to show or prove that you gave somebody paid time off for caring for kids? My guess is when you do your next 941, there will be spots on that form to say how many of the employees you paid during this quarter had sick leave pursuant to a coronavirus.
You mentioned earlier too the need for everyone to document very well the nature of each of their employees throughout this time frame as well. I would emphasize that. I think there's great time. This is a great opportunity for people to be very deliberate about how they're reporting their interactions with employees and documenting the instances of people interacting with FMLA or other payroll tax credits that are in place.
And I would recommend within your payroll software, if you could create payroll items for these specific things, it may be as easy as running a report at the end of the quarter.
Certainly.
By payroll item.
I like that. A couple more questions and then let's get to our last bit here.
All right. If a business, there we go again, it jumped. Let's, I'll go to this one. How would you handle employees who are able to work, needed to work because it's an essential business, but refuse to work because they are worried about the virus? They do not fit into any of the categories of being sick or caring for kids or others that are sick. They just don't want to work. Can we make them use PTO and then off without pay when that runs out? Or does any of the acts still
perhaps apply? Is the
probably
question there. Tim, give us your feedback on that.
So there's a magic number you need to remember as it applies to the FFCLA is 50. If you have fewer than 50 employees, you can elect out of this program.
Well, and I'm sorry to stop you there, Tim. That was something the Secretary of Labor said that we could do. I don't know if he's ever said definitively that that's the case. I don't think we've ever definitively heard that that is okay, but keep going with your thought. I'm sorry.
Okay. The initial language, as I
The
understood
initial
it,
language, certainly.
was that small businesses could elect that, or there's no limit on healthcare workers.
No, healthcare workers certainly being the case, yes. I think this respondent is touching on something that a lot of people are interacting with right now, where people do not want to work because of perhaps some fear or concern. They are deemed essential. They're healthy. They're not falling into a lot of these other provisions. This is a question I think that is best reserved for an employment attorney, to be honest, as it relates to how they interact with that specific individual.
That's a good point.
These are hard questions to answer from a taxation standpoint. My recommendation would be to speak with an employment attorney.
Okay. There was one other one here that let's go to this one because his name is Daniel. Is someone eligible for the extended leave if they are caring for someone other than their children, such as a parent?
I'm going to have to look at the poster. I think, go ahead.
I think relatives were kind of generally included in that language.
You're correct. Relatives were mentioned in that provision directly. So yes, it would qualify in that specific instance.
Okay.
I like that. I know there's a lot of frustrated listeners right now saying, talk about EATL and talk about PPP. That's fine. Let's talk about that right now. This is changing by the hour. It is being interpreted by every advisor and their dog at this point. It is a hard thing to keep on top of. I have had nothing but phone calls regarding this for the last 96 hours. It has been nothing but this.
Can I spend a minute and introduce this for my mom?
Sure, go ahead.
So, Mom, back 3 weeks ago when stimulus bills were starting to be passed, one thing that the Congress authorized was money that the Small Business Administration could get out to employers that would hopefully get them through these tough, hopefully short period of the coronavirus. So one thing that they did is they said, we want these loans to go out to employers, and if they're using it for things that they should, we want these loans to be forgivable without any tax effects. So basically they went two routes. Initially, Congress said, we've got this emergency program for small business owners that happen during times of disaster. Let's just make that available to employers, emergency money, but we'll put a kicker in there that up to $10,000 of this can be treated like a grant. That's a non-taxable grant. The second thing they came out with last Friday was this payroll protection plan, or PPP loan. And that would be anybody who applies for it, again, if they use the money in an appropriate way, not limited to $10,000, could virtually all be forgiven.
Correct. That's a great background on these two loan programs. Right now, business owners, I'm going to talk about maybe 2 or 3 different types of business owners, but business owners right now are trying to evaluate these two programs and how to interact with them right now. The EATL, or the Economic Injury Disaster Loan that you've referenced, has been around for a while, can be applied for on SBA.gov right now. It's a $10,000 grant available to individuals that are impacted by the coronavirus. There is a loan up to $2 million that they would qualify out of that as well. It's a confusing application process, to be honest, Tim. It's difficult not knowing how much you're requesting, how much you're asking for. There's been individuals that have applied over 3 days ago, despite the fact that people thought they'd be hearing back within 3 days. People haven't heard back yet. Okay, so there is some difficulty that people have in knowing where they're at in that application process and really how much aid they're technically asking for. There's difficulty there. The second part is this PPP loan, which is the Paycheck Protection Program that you've mentioned as well, is calculated based on 2.5 times a business owner's average monthly payroll. Okay. Now, we've oscillated between what that payroll number that you're multiplying, what it includes. Does it include independent contractors? Does it not include independent contractors? Most recent, you mentioned we've been updating things as of 3 hours ago. Recent guidance that we're getting from the banks who are speaking directly with SBA is that they're wanting to exclude independent contractor amounts from that calculation at this point. Okay. Now that's in reference to another application date of April 10th that we'll talk about here in just a moment. In short though, I'm a business owner, I had payroll, I'm applying for this program. I hope to procure a loan under PPP equal to 2.5 times my monthly payroll. And I plan to use those funds upon receiving those funds. It's their expectation that I will use that money within 8 weeks to pay for payroll, to pay for rent, pay for mortgage interest, and pay for utilities. And if I adhere to that, certain restrictions and limitations, that has the capacity to be forgiven, to be given to me as a grant that would not have to be repaid and would not be taxable as well. Great opportunity, right? This is hard to navigate though. Number one, if I'm a business owner, I've applied for PPP and I'm not quite sure when that money is going to be available, that certainly has bearing on when I decide to bring employees back from unemployment leave. It has bearing on these credits as well. If I had planned to participate and funds come sooner than I anticipated, it may complicate my interaction with these credits as well. There's a lot that's unknown about these loans as far as their availability and when a business owner should apply. There was conversation, I had been listening to other webinars, and there was conversation that business owners may want to postpone filing because the applications are going to be available tomorrow. There was conversation about waiting and saying, well, maybe you should wait and acknowledge that you only want to receive funds when you're ready to receive them, when you're ready to reinduce your workforce. This is a limited source of income, though, that they're allocating to small business owners. So
First come, first serve.
It's hard to navigate or balance the risk of the funds being unavailable with the strategy that you're trying to employ and reintroducing your employees into the workforce. This is a hard thing for business owners to approach. I love advising my clients and helping them, but there is not a one-size-fits-all answer to this. This is something that each individual has to work with their lender on, their CPA on, and their attorney on to make sure that they're timing things correctly and that they're participating in the programs in the fashion that they hope to. We're going to look back at this time, Tim, and I think we're going to be amazed that we survived it, that we got through it, that we had such proficient lenders that were being so proactive in helping us. I've been so impressed with the lenders that have stepped up and are doing their best to understand these provisions and communicate actively. That communication comes at a cost. That cost is confusion because the guidance is constantly changing and evolving as well. But all the same, we just need to acknowledge that we're all in the same boat, doing our absolute best to understand it and doing our best to position ourselves to procure these funds for our own, for the good of our employees.
I would agree. I keep trying to tell myself that I could come up with a strategic or logical way to maneuver this for everybody, to say this is your decision tree with everything we've been given, but you're exactly right. And I'm going to go back to the statement I made earlier. You need to decide what is going to be the best to keep your business healthy, or at least viable during these difficult times. Besides the credits, we've got the enhanced unemployment available to people. We've got business loans available. So I think it would behoove every business owner to come up with the strategy long-term to say, okay, the best thing I could do for my business, retain these employees, try and get these benefits, try and get this cash flow to get me through this amount of time at least.
Certainly. Some developments that happened today, Tim, that I want clients and others listening to be aware of is they've bifurcated this filing or this application process timeframe. They've said that small business owners and sole proprietors are to apply on April 3rd, and that independent contractors and they used another word there, probably self-employed individuals, are to apply on April 10th. Now, in the realm of CPAs, we have a hard time distinguishing between those four. They all sound like the same person.
It's redundant.
Quite honestly. But April 10th is a second filing date, and based on what I'm understanding right now, might accommodate people that have single owner S corporations. It might accommodate individuals that have an abundance of independent contractor costs, but perhaps not a lot of payroll, or just individuals that are trying to receive an enhanced benefit above and beyond what the EDL is capable of providing, looking at that program as well.
So quick question, do you apply for both loans?
Yeah, great question. So there was, in the myriad of information we've received this week, there's been language saying, if you apply for one, you can't apply for the other. That isn't the case. You can apply for both of them. You have to demonstrate that the funds are being used not for the same purposes, but for different purposes as well. And the PPP, in its current format anyway, will have capacity to refinance existing EDO funds into that PPP loan as well. So the answer is, do you apply for both? The answer is, it depends. There is not a hard and fast answer to that question. I am confident, though, that business owners probably are going to be, if they're not seeking a loan, if they're just looking for funds that will be forgiven, that the PPP long-term probably is going to provide them what they need. But that being said, there is not a hard and fast answer for all of this.
How do you apply for the PPP?
PPP has to go through a traditional lender. It has to go through an SBA lender. So, but your credit unions all the way up to your national banks are accommodating the filing of this PPP loan. And it'd be a recommendation to say that if you haven't spoken with a lender, if you're finding yourself adversely impacted by these things, speak with a lender. Talk to them about what you need. They're very busy right now, but again, they've been very accommodating.
I thought during April, the worst job in the world was a CPA.
Yeah,
Today, it's a banker.
It's being a banker. This is a hard week for bankers. So I don't know. Don't hug a banker. That's not the right thing to do right now, but give a banker a thumbs up. So let's see. Last question here. Would you be able to expand and or give an example of question 3 on the PPP application? I think question 3 is in reference to affiliated groups. I think is my recollection of what question 3 is. Right now, as we presently understand it, they are asking for all entities that you bear common ownership within, or those that have a control group relationship with. There's a lot and that could entail.
That's a 1-hour discussion in and of itself, but basically what they're saying is if you own multiple businesses, you need to consider them all as one as you answer these questions.
Again, yeah, that's a great insight. I think something that we just need to make sure your lender is sensitive to. These lenders are the ones that are going to be helping in the application process. So their interpretation of these laws is paramount. Tim, with that, I think I'm ready to conclude today's webinar. We've gone over time. For those of you that didn't get your questions answered, please know that Tim and I will be reviewing them, doing our best to answer them either in an email or a blog format, or I would ask that you direct your question directly to a representative at Cooper Norman as well. So with that, Brooke, I'm going to turn the time back over to you.
We appreciate your time and your attention, and we're really trying to stay up on this as current as we can make it.
All right. Thank you so much, everyone, for coming. And my email is in the confirmation emails that all of you received. So if you do have a question that you didn't get answered and you would like to send on to Dan and Tim, please feel free to reach out to me and we can do it that way. All right. I'm going to go ahead and close out. So have a wonderful evening, everyone.